The second quarter was impacted by a lot of headwinds.
We're fully staffed, so we're flying about 115% of the capacity that we had pre-COVID.
Inflation is going to stay. At least some of it, labor is going to get more expensive. The big question is, will we have a recession or not?
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's programme. Kicking off in the red, European equities start the week risk off with energy stocks leading to declines as oil prices fall. It is, of course, Fed week. The FOMC gears up for another jumbo hike with inflation at a 40-year high. And earnings coming thick and fast. Big banks and big oil dominate the week with inflation, supply chains, and the energy crisis in focus. The economic data, the earnings, both competing for the attention of investors, of course, as we wait for that decision from the Fed later this week. We have the EFO Business Confidence Index for the month of July, and it is falling. It has fallen once again. We're going to be speaking, by the way, to the head of EFO just in the next 20 minutes or so. The Confidence Index coming in at 88.6, so below the estimates of 90.1. So it's another drop in terms of the EFO Business Sentiment Index and that survey, that gauge on just the robustness, of course, of the German economy. German July EFO Current Assessment Index is 97.7. The estimates were 97.5. Again, we're going to unpack that with the president, with the head of the EFO Institute in the next 20 minutes or so, of course, around concerns that Europe is heading towards a recession, even as the ECB, of course, hiked by 50 basis points last week. We also heard from the Governing Council of the Bank of Latvia, Mr. Kazaks, earlier, about 40 minutes ago, saying that a larger hike would be appropriate as we look ahead to that September decision from the European Central Bank. Across your equities, you're currently seeing euro-dollar, by the way. You're down by 0.2% on the single currency. Of course, the concerns about the euro were flagged by Madame Lagarde. Indeed, they were by Kazaks as well, saying that a weaker euro is not helpful. Across the stock space, then, the benchmark is currently down 0.2%. The context is that over the last month, you've seen gains of a little over 2% across European equities. But again, concerns about inflation and that recessionary risk. Technology, that sector currently down 0.4%. The Bloomberg Dollar Index is essentially range-bound. Bitcoin currently down by 3.3%, just a gauge, of course, of risk and that lower risk sentiment. And you do have, in terms of what's happening across the yield space, a bit of a mixed picture when it comes to US Treasuries versus some of the peripherals here in Europe. Let's change it on, see how things are shaping there up again geographically across this map. The politics of the UK, you have a debate between the two leading contenders to take over from Bojo, a televised debate later today. Currently down 0.3%. More of an impact, of course, is what's happening in basic resources and the energy complex when it comes to European equities today. The DAX is currently down about 0.5%. We're looking at the auto sector. VW is lower. The FTSE 100, the FTSE MIB, I should say, is range-bound. Of course, we know about the political risk now in that country as they gear up for elections. The Spanish IBEX, though, posting gains currently of 0.2%. Over in France, losses of 0.2%. Let's get back then to the central banking action then. Fed Chair Jerome Powell and his colleagues are expected to hike by 75 basis points this week and signal their intention to keep moving higher in the months ahead.
I fully support another 75 basis point increase. However, my base case for July depends on incoming data.
Certainly, the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time, right? Because nothing moved in that direction.
I think they need to go 75 at the next meeting.
You're seeing the Fed move quite aggressively, and in my opinion, very appropriately to get on top of what's significant inflation building in the economy.
The key thing that the Fed worries about, and that we all worry about, is inflation expectations becoming unanchored.
No matter what, whether they go, 50s or 75s, they're still going to be in a situation where the effect on inflation is out into next year.
I think the Fed will have to hold here probably longer. The market's pricing in cuts in early 2023, and that feels a little premature to us.
They've got a tough job ahead of them, but they're using the tools they have, which is to basically raise rates and change the balance sheet.
All right, for more analysis now, we are joined by Guillaume Menuet, Head of EMEA Investment Strategy and Economics at Citi Private Bank. Guillaume, good morning. Thank you for joining us. What is your assumption about the path of rate hikes from the Federal Reserve towards the end of this year and into 2023, particularly given the softer economic data that is now starting to percolate through the system?
We think it's going to be quite difficult for the Federal Reserve to continue hiking into 2023, mainly because there's already been quite a few rate hikes delivered, and maybe because the transmission of much tighter policy stance into the economy could be happening slightly faster than what has been the case previously. So after the summer and after the 75 basis points we are going to get this week, we think that by September onwards, the tone of the Fed might shift a little bit and become a little bit less hawkish, to sit on the amount of tightening that they've had and look at the inflation expectations and the way the economy is behaving.
Well, that's interesting. Is that your assessment? Is your assessment you're not taking too seriously, weighing up the words from Jay Powell and others, that they have this determination to get back down to 2%? Because if they start to pause when it comes to September of this year, that would suggest that 2% target is going to be some way off.
But it's all forecast conditional, of course. And if your inflation forecasts show a smaller overshoot than what your inflation target should be theoretically, then I think the central banks, if you remember, before the COVID crisis, most of them moved the framework slightly to allow for a slight overshooting of inflation. So the 2%, I think, is not absolute. The moment you have a significant disanchoring, that you talk about the 2%. But once you start to approach this 2% on an asymptotic basis, and you look at how much you've hiked already and how much above neutral you might be, I think that the rhetoric starts to moderate slightly. And suddenly you have central banks which are so obsessed about continuing to say, we're going to hike until we get to 2%. Suddenly the rhetoric shifts slightly to say, well, we've hiked quite a lot. The economy has softened quite a lot. How about we start to slow down a little bit and see what's happening next?
Okay, so from the Fed to the ECB then, and the question as to whether or not this TPI tool, the transmission tool, the anti-fragmentation tool, is going to give the ECB, Madame Lagarde, cover to go further on rates. Do you see another 50 basis points from the ECB in September?
I think it's a given. They could even perhaps go to 75 basis points if they thought that the window for interest rate hikes was closing in terms of time because of the acceleration of inflation risks to the upside until we get to almost double-digit territory in autumn, but also if the likelihood of recession was increasing materially. And we've seen the PMIs last week already showing a sub-50 print on a composite basis for the euro area. We see the IFO survey this morning suggesting that all is not well, particularly in the euro area's largest economy, Germany. So I think it's going to be sharp but short. And sharp needs at least 50, perhaps not 75. And by the time you get to the end of the year, the ECB will most likely be done.
Okay, the sharp and short scenario for the ECB. Guillaume Menuet, head of EMEA Investment Strategy and Economics at Citi Private Bank, stays with us. We'll get more of his calls on how to reshape your portfolio in this environment after the break. Coming up, risk-off mood. We discuss the events this week that investors are watching out for, including, of course, that Fed decision, a slew of earnings, and even more economic data. This is Bloomberg.
The second quarter was impacted by a lot of headwinds. We had China lockdown, supply issues, and rising inflation. We have taken decisive action in terms of further improvements on the supply chain, as well as productivity and pricing. We see for the second half of the year a 6 to 9% growth.
That was the CEO of Philips, Frans van Houten, of course, speaking to us earlier about the headwinds the company faced in the second quarter. Inflation, of course, their exposure to China, to name but two. Guillaume Menuet, meanwhile, head of EMEA Investment Strategy and Economics at Citi Private Bank, is still with us. Guillaume, you've been adjusting allocations. You're calling for an adjustment to allocations. How are you repositioning in this environment, and what have the earnings so far told you about the direction of travel for these corporates?
The key, I think, message for the last few quarters was that you have to position portfolios for a significant slowdown in global economic activity, and therefore you have to increase significantly your exposure to quality. We've done this throughout the year through the dividend growers, in particular, those very good quality companies which have got these very good track records of paying dividends to their investors, but also have the pricing power, the right products in the right markets. And that has been, I think, a very successful strategy so far. What we're seeing now is that because of the correction in oil prices, we've taken out the overweights that we had in terms of oil services in particular, but we're staying overweight commodities because we think that, unfortunately, Russia and Ukraine is nowhere to be solved. But we're starting to increase a little bit now on the quality side within the fixed income too. And investment grade credits, in particular in the US, seem to be an attractive place to be. Because, as I said to you at the start, we think that the Fed is probably going to be moderating its rate hiking cycle beyond the summer, early autumn. And the gap that you can see today in terms of yields is starting to get very interesting historically.
And on a sector-by-sector basis, Guillaume, you say that, OK, you're cautious, certainly on European equities, but you say that pharma, food and luxury within European equities remain and deserve to remain in any diversified portfolio.
Yes, because you're talking about sectors in which households will continue to spend a significant amount of money. These are the consumer staples. These are the must-have rather than the need-to-have. Discretionary, I think, is a little bit different. And I think the angle that we're taking from European luxury goods is that if we have this rebound in China, which we think is just a question of time, given the sort of policy impetus out there, these will do relatively well, especially at a time where you see that the euro is so much cheaper. So the domestic angle is in terms of pharma, in terms of food, and the sort of more international angle is luxury, because we think that there's those quality names across those sectors that we mentioned before should do well, both in terms of valuations, but also given where we are in the cycle.
I want to get your views, Guillaume, on technology. Of course, a massive week for the mega cap tech names. There's going to be divergence within this basket, you would assume. How are you looking at technology, and how much and where within that space are you finding opportunities at this point?
So I think the market will continue to differentiate very clearly between the bigger large caps, the mega caps in the tech sector, which have got these recurring revenues as licenses that they roll over and for which they can pretty much charge anything they want to captive customers. And the sort of smaller part of the sector, which might be dependent more on big investment projects that corporates might do in the IT space, which might be curtailed somewhat if the visibility is not there in terms of hiring or investment plans. So a fairly bifurcated market where really the top names should do relatively better. And if we think about the direction of long-term yields as well, and the correlation that used to be there, maybe the sell-off that we saw throughout the first few quarters of the year is probably over in terms of the bigger quality tech names in this world, which have got this built-in.
So just to be clear, and before we let you go, is this the appropriate moment then to be adding to mega cap tech?
I think that we're going to have the discussion, intense discussion in the next few months. But I think it's getting closer to the point where we can see that value emerging here and long-term trends, which we think we want to be exposed to in terms of cybersecurity for the likes, which will have to be in portfolios on a long-term basis.
Okay, interesting. Thank you, Guillaume Menuet, Head of EMEA Investment Strategy and Economics at Citi Private Bank. We appreciate your time this morning, kicking things off for us this Monday morning. Let's get to the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Tom, good morning. The US says a cruise missile strike on Odessa's port cast serious doubt over Russia's commitment to an accord it signed just hours earlier. The deal is intended to facilitate Ukrainian grain exports through the port on the Black Sea. Ukraine's president says his country has about $10 billion in grain waiting to be exported. Now, the chief of the World Health Organization has declared monkeypox an international emergency. The WHO director overruled a divided panel to issue the group's highest alert. The move paves the way for more international cooperation to stop the virus. Liz Truss and Rishi Sunak have both promised to toughen border controls as they battle to become the country's next leader of the Conservative Party and, of course, the next Prime Minister. Sunak says he will tighten the definition of what qualifies for asylum and introduce a cap on those numbers. Truss says she will fully implement the Rwanda policy and increase the UK border force by 20%. And Elon Musk has denied having an affair with Sergey Brin's wife. That's after the Wall Street Journal reported a liaison that led the Google co-founder to sell his investments in Musk's company. Musk has now tweeted that the Journal's report of an affair last December in Miami is not true and that he and Brin still remain friends. Brin filed for divorce from Nicole Shanahan back in January. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Tom.
Leanne, thank you. OK, coming up, IFO Institute President Clemens Fuest on their latest German Business Climate Index. It was not good. That interview is next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, German business confidence deteriorated to the worst level since the early months of the pandemic on growing concerns that record inflation and limited energy supplies from Russia will throw Europe's biggest economy into a recession. Joining us now to discuss the latest data is Clemens Fuest, the IFO Institute President. Clemens, we always appreciate your time coming on for us to break down what is happening within the German economy on the back of this kind of data. Where are we, do you think, in terms of those recession risks? How close is Europe's growth engine of the German economy to that recession now?
Well, the risk is definitely growing. I think there is a likelihood that the third and fourth quarter will be quite bad. Maybe the economy will stagnate, but it might also fall into a recession. And that's really driven by the concern about gas rationing, and it's driven by generally rising prices. So companies are really feeling this. A lot of companies have problems passing on the higher costs, in particular, of course, the higher energy costs.
So there's a problem around passing on those higher energy costs. And of course, we don't have much clarity in terms of Russia and its role in supplying that gas in the months ahead. What is the adjustment that's been made by companies? How successfully have they been able to adjust those higher prices? And do we have any clarity on when those inflationary pressures may start to ease?
Well, I think there are first signs of easing inflationary pressures. Some commodity prices have come down a little bit, also as a result of the cooling of the Chinese economy. Still, companies are reporting they have problems with the high prices and also with supply bottlenecks. At the same time, a lot of companies are trying, for instance, to replace gas by oil. A lot of heating systems are flexible, so they can be put on oil. That's more costly, but it's a possibility. Other companies are trying partly strange things, sometimes replace wood or wood-based materials, trying to burn that instead of gas. But there are wide areas of the economy where that's difficult, in particular in the chemical industry, where gas is needed for both heating and certain processes, production processes. So there are limits to this substitution.
What about the fiscal response from the German government? Is there anything that is being lined up by officials in Berlin to support this economy on the fiscal front?
Well, there is, but it's not easy to support the economy on the fiscal front because this crisis is coming from the supply side. So it's supply restrictions. So popping up demand is in a way counterproductive. What does come from the fiscal side is support for gas providers like Uniper, so preventing a collapse of gas providers. And what's also a possibility is that if companies need to shut down, they will get help to weather the storm. But it's very hard to support the economy in times where the slowdown is coming from the supply side.
Is the biggest drag going forward going to be gas or a hiking ECB?
It certainly is gas and high energy prices. So it's not just gas, it's oil, it's all types of energy, electric energy. The prices are rising, and that is a big problem for manufacturing. The hike of the ECB is in a way already priced in. So financing costs have increased, and that's felt in particular in construction, where we see rather negative data. A lot of construction projects are cancelled, really, and this is due to high prices, but also due to high interest rates, high financing costs.
Okay. Clemens Fuß, always fascinating. Thank you. Appreciate your time. President of the IFO Institute on that weakening index. Coming up, this is the end. Yes, VW ousting its CEO. We'll get the latest on that story. This is Bloomberg. Kicking off in the red, European equities start the week risk off with energy stocks leading declines as oil prices fall. It is Fed week. The FOMC gears up for another jumbo hike with inflation at a 40-year high. And earnings come thick and fast. Big banks and big oil dominate the week with inflation, supply chains, and the energy crisis in focus. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Let's check in on your markets then. You are seeing a moderation of the heavier losses we saw at the start of the session around an hour and a half ago, just down about 0.2% across the benchmark European equities. Futures stateside range bound. The Nasdaq futures lower by 0.1%, higher by 0.1%, I should say. Across your sectors here in Europe, yes, leading the losses is energy, currently down 1.3%. Oil is lower. Banks, though, at the top of the list in the green, gaining 1.2%. Let's get to what's happening in the auto sector then. The auto sector, by the way, is also off by about 0.4%. There's the corporate story. Volkswagen abruptly ousting its CEO, Herbert Diess, on Friday, appointing the boss of Porsche as his successor. The move ends Diess's 4-year tenure at the helm of the automaker. We had led its massive electric car push. For more, we are joined by our auto star, Craig Trudell. Craig, why did VW make this move? Didn't they recently re-sign the contract with Diess? What was behind this?
They did, and he's been through so many brushes with kind of votes on his future with the company. It looks like he was going to emerge unscathed. Ultimately, it was not just the frequent clashes that he's had with labor leaders, that really sort of led the Porsche and PS families to have to sort of come to his defense. It was software, interestingly enough. So in the along with that announcement of his contract being extended, he took over the Cariad software unit. That unit has been really, frankly, just a mess, and there are multiple models that are being pushed back because of concerns about software development. It's really, proved to be challenging for VW to take these disparate units internally, put it, harmoniously run that organization and not set back schedules for new model launches, and that ultimately proved to be his undoing.
And those model launches have been set back in some cases as a result of this. So that's the software component. What about the shift to EVs, though, and the labour component? Should we take from this the friction he's had with the labour? Do we take from that and learn from that maybe the shift to EVs is going to be held up as a result of that?
Well, Oliver Blume is going to have some real challenges to confront, because I think if any signal that Volkswagen is going to pull back at all on its electric car ambitions is not going to be taken well by the market. Of course, Porsche has been...
You've got to continue that shift whilst keeping the workers happy, because it does involve, for many companies, laying off.
And that's going to be a tightrope to have to walk, right? Because you have even Ford in the last few weeks talking about investing in plants in Spain, and yet bringing employment down in that factory, and that gives you an indication of just how much labor is at risk, in the sense that you're going from a combustion engine that has so many moving parts, so many components, to a battery that is much simpler to make, much simpler to assemble. You need less labor for that, and so there's going to be this need to continue this momentum with electric. Porsche has been a success story in that respect, but he's going to have to keep that going for the broader group and find a way to do that potentially while reorganizing the company and bringing some job losses with it.
What else do we know about Bloomer, the man himself, and his past history, his resume, and again, some of those urgent tasks that he's going to have to address beyond the questions of software and that shift?
Volkswagen has really emphasized his, sort of team player mentality. He's been with the company a long time. I think that was one of the challenges that Diess had, was he was an outsider, right? He was brought in from BMW. He was, sort of put forward as this is the guy who's going to lead us out of the Dieselgate mess. He put the company on the right track in terms of electrification and had, a really strong vision, and that resonated with the market, at least for a period. I think ultimately it was just the execution that was the challenge. And so the bet here is that this guy who knows how to navigate VW, which is no easy task, is going to be able to do that and have some better success in terms of executing the course that Diess has set them on. Okay,
very interesting corporate story. We'll, of course, be following what happens with Bloomer and the success or not that he has. Thank you, of course, to Bloomberg's Carter, Craig Trudell. VW, by the way, currently trading down by 3.6%. To another big corporate, the importance of wealth management. Julius Baer profits slumped in the first half of 2022. That's as wild market swings spooked clients and eroded assets in the firm overseas. The firm overseas, for the rich, of course. The Swiss Private Bank's assets under management fell 11%, reflecting market declines and a 1.1 billion franc in net redemptions. For more on this, our anchor Manus Cranny, who interviewed the CEO of Julius Baer earlier, knows this story so much better than anyone else. Manus, what for you was the key takeaway then?
That perhaps the deleveraging that was the hallmark of the first 6 months of the year, Tom, could be coming towards a basing out. And I think that's reflective in terms of where did you see the deleveraging? Well, that was in Asia. Where did you see the outflows? Again, a very Asia-centric private wealth business here by Julius Baer. I caught up with Philip Rickenbacker, the CEO. The market was very initially unconvinced by the headlines. And then we talked about the turn and is the worst past. Let's take a listen.
Inflation is going to stay. At least some of it, labor is going to get more expensive. The big question is, will we have a recession or not? I think current signals are no. There might still be a soft landing, but you never know. The percentages change fast. So I think clients need to prepare for different macroeconomic scenarios.
And that risk of recession is what drove the deleveraging, the hiding in cash. And we chatted about whether it's time, a bit like the Bank of America note, Tom, which is, are we pivoting from deep fear and take a contrarian position right now and re-leverage? He said they stored in cash, they deleveraged to protect themselves, to give themselves firepower. But it's been really, really quick. The turnaround in inflows has been quick and rapid in the past month and a half. And that lays the groundwork for, you got it, more business and higher ticket writing at the wealth management business.
So maybe a more solid groundwork then for that business going forward in the weeks and months ahead. A very different story, though, around UBS and Credit Suisse, Manus. What are you going to be looking at?
Completely. So the UBS story is very much around what pain did they take on the investment bank scenario. You saw it in the US in terms of deals and in terms of flow. So that pressure on the investment bank. What I will be keen to get a handle on with Ralph Hamers is, how did your outflows go in the second quarter? Is the deleveraging past? And I think it will be much more material because it's just the size of UBS is so much more of a quantum in terms of whether we are at the nadir of deleveraging and de-risking. So we'll catch up with Ralph on that. I think then when you get down Bahnhofstrasse and you get into Credit Suisse, you're in a completely different scenario. A CEO fighting to remain, a CEO fighting for institutional backing, a CEO that may have to do job cuts in Asia to make up for some of the deleveraging. So really a triptych of banks with three very, very different stories ongoing. Tom, I think the question now is whether you believe it's a moment for everybody to take a contrarian view and to retake some risk. I'm being outshone for once in my career by a very elegant young lady here, screaming down the banks of the Zurich River.
Screaming down back. Listen, if you weren't interested in Swiss banking before, you certainly should be now, particularly Manus's insights and that beautiful backdrop. We're looking
Riveted.
at those other stories, of course. Riveted. Thank you, Manus, as ever. Of course, our Daybreak Europe anchor in Zurich. And he's got plenty more from Manus in the days ahead. Coming up, we're going to speak to the governor of the Bank of Italy, Ignazio Visco. That interview is next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, Italy has been at the centre of attention in Europe, of course, in the last week. An election is set for September 25th to usher in a new administration after the collapse of the Draghi government. Current polling suggests a right-wing coalition has a strong shot at ruling Italy after the elections. All of this, of course, coming as the ECB hiked 50 basis points and, of course, unveiled details around the TPI. That is the transmission protection, of course, tool, or the anti-fragmentation tool. For all of these topics, who better then to speak to the governor of the Bank of Italy, Ignazio Visco. Governor, thank you very much for joining us. And on the question of the European Central Bank, we heard from one of your colleagues, in fact, from the Bank of Latvia, suggesting that another larger rate hike in September is appropriate. Would you align with the view that maybe another 50 basis points would be appropriate in September? Or has the front loading that we saw of last week given the ECB the opportunity to take a more moderate approach?
Well, obviously, we have decided to take decisions meeting after meeting. So there is no way now to say whether it will be appropriate 50, 25, or whatever. What we have decided was to front load an increase in interest rate that is basically a normalization. So we ended out from the negative interest rates, and we will see, depending on data, how to go on. But clearly, this does not mean that we are not going to proceed in a gradual way. Graduality means moving step by step, not being very slow. And we are moving step by step simply because the inflation rate turned out higher than it was projected for a number of reasons. Interest rates, therefore, in real terms, were lower. And I think that we simply did a front loading of what had to be done. Markets have understood very well. There is no particular reaction. It is no time now really to ask for higher interest rates than we had up to now foreseen. Thank you.
Governor, how difficult was it to agree on that 50 basis points amongst the members last week?
It was not difficult. There was a long discussion, obviously. We have considered, as usual, all the elements for a decision. We had said in June in Amsterdam that we intended to raise by 25 basis points our official rates in July. And then actually inflation persistently was maintained at a higher level than it was expected, not only by us, by markets, by futures and so on. And the reason is simply linked to the protraction of these incredible war in Ukraine. And this implies that the energy prices have been maintained much higher than expected. As a matter of fact, the gas prices increased up to 150 euros per megawatt hour, which means basically almost double than what they were in the spring and extremely more than they were last year. So in this sense, it was simply a way to, as I said, front load our normalization path.
Okay, the importance of front loading, and of course you stress the importance of graduality as well, and taking it meeting by meeting. I just wonder, Governor, if we're able to get any clarity, given the data you're looking at now, as to where you see ultimately rates going, when you expect rates to peak, and at what level?
When I expect what? I don't understand.
What should I expect?
I wanted to get your views on when you expect rates to peak, when you expect them to get to the highest point they can get to, and on what kind of level you might be looking at this point.
No, I don't. So far, the conditions are such that both inflation expectations, wage prices, they are doing more or less in relatively positive way, reacting to this increase in energy prices, in inflation, and so on. Obviously, they may increase, and this is the reason why we normalize and we try to take care of the what we call second round effects by avoiding that there is an increase in demand. But actually now we are in a very different situation still with respect to other areas of the world. There is no major demand pressure yet, and the path of interest rates rises of normalization is going to somehow counter the risks. I don't see it really getting out of our hands. It seems to me that we are proceeding as expected. And obviously, the TPI is an instrument now that will help us to avoid excessive volatility, disorderly movements in markets following our decisions, and somehow misunderstanding what really the risks are.
And on the TPI, Governor, do you see any chance that Italy will indeed qualify for that kind of instrument?
Well, Italy, as any other country, TPI is an instrument that basically is designed not to protect a single country, but really to maintain a smooth transmission of monetary policy, which is meant to achieve price stability. Now, this is something that has to do with the incompleteness of our monetary union. We don't have a well-functioning banking union. We have delays in the capital market union, not to say the fiscal clearly union or steps towards that, which are crucial for monetary policy to have a single counterpart in the macroeconomic framework. So in this sense, we are looking to a number of issues. The Governing Council will be autonomous in deciding when and how to intervene. The conditions are standard conditions. That is, we have basically the maintenance of agreement with the EU fiscal framework, the sustainability of fiscal conditions, the macroeconomic imbalances not to be there, and especially I also would say the permanence of sound and sustainable macroeconomic policies, which is something different from the developments of political systems. So any political change will come with different or possible maintaining the main policy decisions, objectives, frameworks, and so on. And the markets, as well as us, will have to value how much these will imply that the conditions are sustainable, and therefore any disorderly movements in markets will be unwarranted. The word unwarranted is really crucial.
Okay, unwarranted market moves is what we're looking at. And so far, the reaction from Italian debt BTPs is, as you said, relatively muted. But on the question of politics then, and of course, political risk in Italy back on the front pages last week, if we do get to a point where BTPs, where Italian debt yields are blowing out, whether it's 250 versus the Bunds or 300, and it is down to political risk, the suggestion is that the TPI tool would then not apply. What would happen in that context if a blowout of a spreads, but that is tied to political risk? What would then be the reaction to that?
I understand. The issue here is whether our policy changes and decisions have been interpreted by the market in making conditions more difficult for the Italian debt and so on. This is not so. At the end, there has been some turmoil, and I still think that the current spread with respect to German bonds is somehow much higher than what would be justified by the macroeconomic fundamentals of the country. But this is still something that has to do with the uncertainty the market sees in terms of policies. We have to really look at what will be at the end the policy framework that will take place in the country. I don't see particular risk up to now. I think that the most important thing for Italy is to maintain the ability to return to a higher rate of growth than the one we had experienced in the last 15 years or so, or 20 perhaps. And the issue here is very simple. Much of the rise in the debt-to-income ratios, to GDP ratios, is due not to fiscal inability to be prudent or careful, even if I'm sure that much better could have been done in terms of distinguishing between current expenditures and expenditures for public investment. But at the end, it will be extremely important, the increase in GDP. If we had a GDP increase in the last 15 years as the one it was after the monetary union until the financial crisis, it would have been much below 100% today, the debt GDP ratio. So, I mean, this is really the crucial, what the policies will be, but the objectives are very clear, and the political system, I think, will have to follow those objectives as the way set by the Draghi government.
Governor, we are very fortunate to have your insights and to have you on today. We do appreciate it. Thank you very much indeed. Of course, Ignazio Visco, the governor of the Bank of Italy. Coming up, travel chaos continues to plague airlines. We will focus on Ryanair next. This is Bloomberg.
We're fully staffed, so we're flying about 115% of the capacity that we had pre-COVID, and the plan is to grow from 149 million customers pre-COVID to 165 million in the current financial year, which is up from 97 million last year.
That was the CFO of Ryanair, Neil Sorahan, speaking to us earlier. We are now joined by Sid Phillip, our European airlines and autos reporter, on the back of a decent set of numbers from Ryanair. How do they manage to navigate the summer when everyone else failed to get their staffing in place?
So Ryanair is unique among most European carriers in that during the height of the pandemic, when airlines, including British Airways, laying off as many as 10,000 workers, and EasyJet was cutting 2,000 workers, Ryanair didn't keep workers on. It just it kept them on. It kept them on lower pay. It reached negotiating agreements with unions to cut pay, and that helped them keep staff on. And so when the demand came back, they were able to ramp up quickly and sort of scale up there.
OK, success story for Ryanair. Thank you, Sid Phillips, of course, our European airlines and autos reporter. Plenty more coming up. Stay with us. This is Bloomberg.
We have heard from a lot of companies that they're thinking the following environment is going to be more challenging.
We're at an inflection point, and markets are essentially trying to figure out if they need to follow the nominal growth or the real growth.
We're going to see much lower growth in the second half of this year.
A mild recession is certainly in the offing.
We're seeing signs that global economic growth is decelerating at a pretty rapid clip here.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Central banks signal that more large rate hikes are on the way. The Fed is set for another big increase this week. And an ECB policymaker says that stronger hikes may not be over after last week's move. European bank earnings season is underway. Julius Baer sees its profits fall. Meanwhile, Credit Suisse reportedly is considering job cuts. And the WHO sounds the alarm on the spread of monkeypox. We'll talk with the organisation's senior emergency officer. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. Kailey, it is Monday once again. A lot of European earnings to talk about this week and a Fed decision crucially in the middle.
Yeah, it's going to be a busy one, Anna, especially with the mega cap tech stocks reporting here in the U.S. throughout the week as well. So we're awaiting those results. But of course, to start the week this week, recession fears are still very much front and center, and that weighed on risk sentiment in Asia overnight. A broad down day for most of the major benchmarks in the region. The MSCI Asia Pacific Index as a whole falling by about 0.5%. One group of stocks that bucked that trend, though, was actually Chinese property stocks. This is after a report that the China State Council is looking to approve a fund to help support some of those developers. So if approved, it would be one of the most direct ways yet that they are intervening in the property market, which remains in turmoil. So those property stocks up about 1.7%, and you saw a little bit of lift to high yield bonds in China as well. Speaking of bonds in China, we have to talk about sovereign debt as well, because at one point earlier in the session, the Chinese 10-year yield was actually above that of the U.S. 10-year Treasury yield, right now sitting at 278. And I think we're seeing a little bit of selling pressure coming into Treasuries, Matt, so that story changing, but still one to watch as we've seen that yield here in the U.S. coming down substantially in recent days. And finally, in foreign exchange, your Japanese yen is the big underperformer in Asia. It's weaker against the dollar this morning, trading at 136.40, Matt.
It looks so strong at 136 nonetheless. I'm taking a look at S&P futures that are actually rising this morning. So there's a lot of talk about recession fear, especially over the weekend, especially ahead of the Fed meeting on Wednesday when we're expecting a 75 basis point hike. Nonetheless, we have futures in positive territory and investors are letting go of 10-year paper right now, floating up about 5.5 basis points, but only to 280. Remember, we saw that huge drop in this rate last week. I think in two sessions we saw 27 basis points fall away from the 10-year yield. NYMEX crude right now down 17 cents a barrel to 94.53, 94.49, so now holding at a relatively low level. And Bitcoin also falling 3%. This, I'm going to say, measured from yesterday's price, although it could be 5 p.m. on Friday. In any case, it's still at 22,000, so still looking pretty strong from the 20,000 levels that we saw for so long. Anna, what do you see in terms of European stocks?
We're a little bit directionless, Matt, in all honesty, here on the European stocks picture. It's such a busy week ahead, perhaps waiting for a few clues, certainly from the Fed and also from the European earnings and, as Kailey said, the big tech picture over in the United States. So things look pretty muted right now. We started in negative territory, factoring in some of the weakness that we saw in the US on Friday around tech and telecoms. All of that was playing weakly in the US, and so Europe had to play a bit of catch-up with that. But we've since recovered our poise, and we're now pretty flat across European equity markets. Let's have a look at where we are seeing some of the bigger movement, and we have some movement in the energy sector to talk about. Energy prices are a little bit weaker, and we do see that the energy stocks here in Europe are down by 0.8%. We've got a lot of corporates reporting this week, including some of the energy names. Interesting, you were talking about the sort of dance that we've seen on treasuries with those yields coming down substantially over recent days, as last week's weak data on both sides of the Atlantic sent people into the perceived safety of those government debt markets. That brought those yields down. Well, today we're seeing a little bit of a reversal in that, and that's what we see in the German two-year yield. Even if the data continues to be weak, we've certainly had some warnings about recession once again over in Germany. Philips, the share price of this medical devices business, down by 10.4%. And just as a reminder, we're still dealing with supply chain issues very much attached to China and particular to COVID policy. We heard from the CEO of that business calling for a change there. And I put in Eutelsat because this is a fascinating story. Europe has for a long time talked about trying to create a rival to Elon Musk's activities in space. And of course, Europe is far behind on this front. But this is a French-listed business trying to acquire a UK-based rival and trying to scale up on that front. But there are so many government stakes in both of those businesses that there are a lot of execution risks, let's say. Kailey.
All right, Anna, well, we will continue to keep an eye on that story. And as we've been discussing, there is a lot to keep an eye on this week. So let's take a look at what is ahead. As I mentioned, big tech earnings will continue. We got Alphabet, Apple and Amazon reporting, as well as the likes of Meta. So we'll see how those advertising headwinds are affecting some of those bigger cap players. Then European bank earnings will be taking place as well. UBS, Credit Suisse, and Deutsche Bank all will be reporting throughout the course of the week. Of course, it's the Fed rate decision on Wednesday. Will they move another 75 basis points? Then on Thursday, we'll get second quarter GDP data from the U.S., and we'll be getting Europe data as well. CPI on Thursday and GDP on Friday, Matt.
So a lot of data coming out, and a lot of exciting earnings coming out as well. Concern about the economy has really taken up the weekend nonetheless. Treasury Secretary Janet Yellen expressed confidence in the Fed's fight against inflation. She spoke in an interview on NBC's Meet the Press yesterday.
We're likely to see some slowing of job creation, but I don't think that that's a recession. A recession is broad-based weakness in the economy. We're not seeing that now.
Fed Chair Jerome Powell and his colleagues are expected to boost rates 75 basis points again this week and signal their intent to move higher in the months ahead. Joining us now for more is Michelle Jamrisco, our senior Asia economy reporter. Michelle, how are Fed officials doing in trying to convince everybody that they can achieve a soft landing?
Well, not so good, Matt. I mean, I think that divergence between the officials on one side and the economists and market participants on the other is a growing one, and it's unsettling now. You did hear from Treasury Secretary Janet Yellen yesterday, kind of echoing what Jerome Powell has said, that they can achieve that soft landing, that they can find a way to avert recession. Of course, we heard 2 weeks ago from Fed Governor Waller that he said it was inconceivable that the economy would go into recession at this point with 3.6% unemployment. So they're certainly making their case, but yes, it's growing more and more skepticism in the market and among economists that they can achieve that. It's a very narrow path to make sure that that job slowing doesn't become a recession. And in two ways, it's quite complicated. One, the Fed is still dealing with some supply side inflation, which of course is less controllable and more unpredictable, in this case stemming from the war in Ukraine. And at the same time, monetary policy works with a lag, as we're reminded. So, there's kind of a race to win that inflation fight before unemployment ticks up to a level that they'll have to kind of ease again. So it's very unsettling at this point, and not everyone is convinced.
Well, and of course, that's the picture in the U.S., Michelle. And in Europe, we have seen a string of really not great economic data points. Yet at the same time, the ECB Governor Martin Kazak's out speaking today, saying that the central bank could keep adding big hikes even after last week's 50 basis point move. What was your main takeaway from his comments earlier this morning?
Yeah, it was interesting, Kailey. I mean, we were talking last week about whether forward guidance is dead, of course, with the ECB moving with 50 basis points after really signaling hard, especially from the top, and Christine Lagarde saying it would be 25 or signaling it would be 25. So now we're hearing that this isn't over, that maybe they didn't get out of their system with this shock hike, that perhaps they'll have, equivalent or some big sort of hike in September as well. I think to me, it just says expect the unexpected. We're in uncertain times, given especially the uncertainty around the war in Ukraine again and its impact in Europe. A lot of what Kazak's was saying, and we know him to be among the most hawkish of the ECB officials on the Governing Council. But what he was saying seemed entirely reasonable. He said they're open to discussions. He said they're not just going to follow the Fed. And he said there is significant downside risks. All things that you would expect central bankers to say today. But the bar is low right now for information. So even getting this idea that they could go again with a big hike is something to be noted today.
Yeah, and thank you very much, Michelle Jamrisco there with analysis of the US and European economies. And one of the headwinds hanging over the European economy is, of course, gas supply from Russia. With that in mind, worth noting that the Kremlin has said this morning Russia is not interested in cutting off gas to Europe. Russia says it will ship as much gas as is technically possible via Nord Stream 1. We will see what actually comes to pass through the fall, the autumn and into the winter. Now, Julius Baer's profits slumped in the first half of the year as volatile markets spooked clients and eroded assets the firm oversees for the rich. The CEO of the Swiss bank explained this profit slump to Bloomberg's Manus Cranny in Zurich.
This was a resilient result under very difficult market circumstances. I think the first half of this year has been, as some said, the most exceptional circumstances in decades. I think we did feel that geopolitically, macroeconomically. I think the worst is through, at least from what we've seen. And I don't think it was just fear, it was also caution.
Bloomberg's Manus Cranny joins us now from Zurich. He said then that the worst might be over, Manus. That was the positives, but there were some negatives as well.
Look, quite a bullish call, I thought, from Rickenbacker when I sat down with him a little bit earlier this morning. The question as we go into both Julius Baer, UBS and Credit Suisse is whether the deleveraging, de-risking and pivot to cash has really passed. His take was clients really hid. That fear that gripped the clients in the first half of the year may just abate ever so slightly. And that, I think, is the issue as to whether clients re-engage, reload and refuel for risk on the upside. It's the Bank of America note sentiment, isn't it, which is buy now. In other words, be a contrarian. But he quite liked credit. He said you can't avoid equities. And indeed, I thought he was trying to sell a bullish story on the back of lower fee income. And yes, new money came in, but the analysts are saying on the call here that that's just not enough in May and June to turn the story around. Anna.
Manus, apparently there's some mulling going on in Zurich with regards to job cuts. Credit Suisse looking to cut costs. What do we know?
Well, Credit Suisse is a very different story, structurally different. Yes, both Julius Baer and Credit Suisse both have massive exposure to Asia. You have a CEO of Credit Suisse who is under huge pressure from the board, from shareholders. Gottstein has got to show. He's got to show that he's in command, show that he's in control. And that may well mean some aggressive pivot to cost cuts and job losses at Credit Suisse to rein in the costs and display, I am the CEO, I am here for longer than a long summer.
All right, Bloomberg's Manus Cranny reporting from Zurich. Thank you so much. Let's turn to Washington now. President Biden's doctor says there are encouraging signs that he is overcoming the coronavirus. The White House physician noted in a daily update that the president's symptoms continue to improve significantly. He's being treated with Pfizer's drug Paxlovid. Meanwhile, the World Health Organization's head has declared the monkeypox outbreak a public health emergency of international concern. The virus has spread to about 16,000 people in more than 70 countries in just a few months. Let's get to Anne-Marie Horder, and Bloomberg Washington correspondent, for the latest on the White House response. Anne-Marie?
Well, the big question coming off the heels of this declaration from the WHO over the weekend, of course, is whether or not the U.S. would itself declare monkeypox an emergency. And the White House COVID coordinator, Ashish Jha, was asked about this on Friday, and he said that it was being weighed. He was asked about it again on the Sunday shows, and there was no new news to bring in terms of an emergency. They do think they can contain it. Right now, the U.S. is able to have vaccinations of about 300,000. They're able to test 80,000 people a week. And from Ashish Jha, as well as Anthony Fauci, it does seem like they're going to be ramping it up. The big question, though, would be whether or not they declare an emergency. And Dr. Jha had said the point of declaring an emergency is whether or not that would actually give us more tools, what we could do with that emergency to implicate change. But right now, it is something that they're just weighing at the moment. So no emergency yet in the United States. If it were to come, it would be declared by the U.S. Health and Human Services.
Anne-Marie, thanks very much. Bloomberg's Anne-Marie Horder reporting from Washington. Later this hour, we'll hear from Dr. Catherine Smallwood, Senior Emergency Officer at the World Health Organization, get the latest on monkeypox. Now, Volkswagen's dramatic move to oust its CEO was set in motion a week ago when his backing from the billionaire Porsche and Piech family began to crumble. Following key project failures and worker discontent, the family concluded he had to go. Craig Trudell joins us once again, Global Car Czar, on the thinking behind the VW move. This really surprised the markets, but it was after the markets closed on Friday, European time, Craig. So today is the first time that European stocks have had a chance to react to this, and it's quite a negative one. What do we know about why he had to go? This guy was in charge of the big electric push.
Yeah, and I think he got a lot of credit for really, being aggressive in taking a company that was just a few years removed from the Dieselgate scandal when he took over and putting it on this path of having the biggest, broadest electric vehicle offering. I think that the challenge for Volkswagen really has been not just switching over powertrain, but really sort of modernizing its cars and sort of, going punch for punch with Tesla on the software aspect. You still have a situation where you're not, getting over-the-air updates to your car the way you get with your iPhone or with your Tesla. And that's something that Volkswagen has tried to replicate and really struggled to.
And of course, the big challenge for Volkswagen is governance. They have this albatross of workers' boards and government stakeholders that are weighing in on every decision, so the CEO can't really operate freely, as we have seen. What is the new CEO going to do? Oliver Blume, he's already busy enough at Porsche, right? And they're preparing to IPO. You'd think investors would want an independent man in charge, but he's going to have a lot more to do.
Yeah, you nailed it on the head, Matt. I mean, that is one of the big sort of, common threads in the way the market is reacting to this news. It's, this idea that Blume is not only taking on this massive job and having to answer to all those various stakeholders that you referred to, he's also keeping the Porsche job and doing that while they're trying to take Porsche public, is only sort of adding to the governance concerns that you raise. And Porsche's, sort of overlap in ownership and the shareholdings of these companies. It's a bit of a mess for shareholders to sort of untangle and get comfortable with in terms of buying shares in Porsche. So that is, likely why, contributing to why you're seeing, the stock trading down this morning.
All right, Bloomberg's Craig Trudell, thank you so much. Now, speaking of stocks turning down, let's take a look at some stocks moving in pre-market trading here in the U.S. because one of the biggest underperformers is Moderna. This may be due to news over the weekend that the U.S. is putting COVID booster shots, additional ones for those under 50, on hold. That, according to the Washington Post. Moderna down about 3.3%. Also moving lower, a lot of cryptocurrency-tied stocks because we are seeing Bitcoin and other crypto prices under pressure today. Coinbase, the exchange, is one of them, down about 2 percentage points. And finally, I just wanted to get a check on Snap as well because the price action on Friday was brutal. The stock down 39% after disappointing revenue thanks to the slowdown in advertising online. Interestingly, though, the stock is up about 0.4%, so maybe just the smallest amount of dip buying coming in. But of course, this is now a stock down almost 80% year to date, Anna.
Yeah, don't call it a comeback, perhaps. Don't call it a bounce back then, Kailey. Coming up, we will talk about the markets with Mark Andersen, UBS co-head of Global Asset Allocation. We'll talk about the Fed, talk about the earnings stories we've seen so far. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both radio and television, and we're looking ahead to Wednesday's Fed meeting. Are there still any investors out there betting on a 100 basis point hike? Cue chart. Let's bring in Tatiana Day right now to talk about the possibilities of that as well as broader market implications this week. Tatiana, thanks for coming in early again with us. What do you think about the possibility of not just 75, but even 100 full basis points?
Yeah, well, I think such a historic move is somewhat unlikely now just because it hasn't been telegraphed as well. But as we know from last time, the Fed only gave us a few days worth of notice, so perhaps it's not yet too late. But broadly, they have the Fed speakers have pushed back on this idea and are still expected to go 75 basis points. But I think broadly markets are now not only pushing back on 100 basis points, they're pushing back on even more. If you look year to year into the year end, they're expecting the Fed to stop hiking in December and start cutting rates here in February, just given that the economic data has worsened here. And I just worry it's a little bit premature for that, for us to have that conviction yet.
Well, the idea being that the economy is going to slow down enough that it causes the Fed to blink to a certain extent. And you're seeing the fears around a slowdown reflected in the equity market because even though, yes, we've been rallying, it's the more defensive areas.
Yes, that happened on Friday, which represents sort of a shift from what we've seen this month so far. So on Friday, after those ugly PMIs, we've seen investors sort of pile into your classic defensive like utilities, consumer staples, real estate. But that represents a shift from what has been traded during the month of July. If we look at this rebound, it has largely been a risk on. If you look across factors, high beta stocks have actually outperformed. And that's not only your tech names, but also your travel, leisure, and other consumer discretionary, as well as your biotech, which really suggests some sort of a risk appetite there. Also, it doesn't really rhyme with a recession story, but at the same time, there's this idea that if we get a recession, it's going to be shallow, so it won't hurt stocks, much more than it has. So therefore, it's a good time to buy stocks.
Tatiana. Thank you very much, Tatiana Dario from Bloomberg Markets Live. And for more market analysis, check out the Markets Live blog. MLIV Go is the function to use on your terminal. This is Bloomberg.
Now, keeping you up to date with news from around the world, here's the first word. The U.S. says that a Russian cruise missile strike on the port of Odessa cast doubt on Moscow's commitment to the agreement on Ukrainian grain exports. The deal for safe shipment corridors was signed after months of talks. Russia said the missile attack targeted Ukrainian military infrastructure. And Elon Musk is denying he had an affair with Sergey Brin's wife. According to the Wall Street Journal, the alleged affair took place in December, which led Brin, the co-founder of Google, to sell his investments in Musk's companies. Musk says the story is untrue and he is still friends with Brin. Brin filed for divorce from his wife in January. Coming up, we'll get back to the markets and have a conversation with Mark Andersen, UBS co-head of Global Asset Allocation. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Central banks signal that more large rate hikes are on the way. The Fed is set for another big increase this week. And an ECB policymaker says that stronger hikes may not be over after last week's move. European bank earnings season is underway. Julius Baer sees its profit fall. Meanwhile, Credit Suisse reportedly is considering job cuts. And the WHO sounds the alarm on the spread of monkeypox. We will talk to the organisation's senior emergency officer. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Matt, no doubt the Fed will dominate, but also big tech earnings and plenty of European corporates reporting this week as well, including the European banks.
Yes, and General Motors, I remind you, in about 24 hours from now. Nonetheless, it does look like we're still seeing gains on futures, so maybe the market is positive about those earnings or those data points or the Fed meeting on Wednesday, 75 basis points priced in. We have the 10-year yield coming back up almost 6 basis points, but it had fallen dramatically over just a few sessions last week, so we're at 280.87 right now. And NYMEX crude turning back around, heading higher from where we saw it just a half hour ago, up about 82 cents a barrel to 95.50, still holding well above 100. And then Bitcoin finally down 3% from yesterday. Also Friday, we had a really strong day. It was well over 23,000, but it's still at 22,024. Kailey, what do you see in terms of the pre-market movers?
Well, a lot of them are tied to that move lower in Bitcoin, and that crypto-related equities are under pressure. The likes of Marathon Digital, which is down 2.3%. Coinbase, the big exchange, is down 1.6% as well. And interestingly, you're seeing some pressure in the energy space, even though oil is just a little bit higher on the day. Where the real weakness is coming from is actually the oil field services. Their likes of Baker Hughes and Halliburton, each down the ballpark of 1%, though we know that some of those services companies are facing supply chain issues, inflationary pressures. So goes the story with so many companies in this kind of environment, Anna.
Absolutely. Kailey, let's have a look at what's going on in European equity markets. So after starting the day in negative territory, we've managed to turn that around, up by just 0.1%. So much still lies ahead of us this week, from the Fed to the earnings story. So maybe a pause for thought in the meantime. Did we make too much of those moves in bond markets last week? Did the markets make too much of those? And the weakness of the data, which drove investors into the perceived safety of government debt? We're unwinding just a little bit of that at the margin today. That's what we see on the German 2-year yield. Philips is really interesting as an earnings story. One to get this week started here in Europe, down by 10.7% on the back of the earnings report. And it really is concern around their supply chains and China that still is weighing on this company, along with some other issues. But that's a real reminder to us that we're not through the COVID concerns. Of course, those policies still in place there. And Eutelsat, this is down by nearly 17%. This is an interesting European attempt to try and build some kind of rivalry to Elon Musk and SpaceX. Long behind, or far behind, in that endeavour, of course. But interesting that they're still attempting to do so. And this is Eutelsat trying to do a deal with OneWeb in the UK, but there are so many government shareholdings in here that it does seem as if it could be a long slog to getting some sort of M&A done in that space, Kailey.
All right, maybe a lot of red tape to cut through, Anna. Let's keep the conversation on Europe. Joining us now is Mark Andersen, UBS co-head of Global Asset Allocation. Mark, there's just a couple bits of news out this morning. On the one hand, you had EFO confidence in Germany falling to the lowest level since the early days of the pandemic. At the same time, you have Martin Kazaks of the ECB saying that the 50 basis point move we saw last week shouldn't be the only front loading. They think another rate increase in September also needs to be quite significant. This is an ECB that the data is telling us is hiking into weakness. Can you touch Europe with a 10-foot pole right now?
I think Europe is certainly a difficult place to invest. I think you mentioned all the important ones. So we see the IFO definitely down today. The expectation component is reminding us that a European recession is certainly a high probability event. ECB hiked 50 basis points last week. They're likely to do it again at their next meeting. So with this kind of backdrop, obviously European equity markets have suffered year to date and quite significantly, are down trading with at a 20% discount to kind of its US peers in some of the sectors that we compare it to. So a lot is also in the price, but we think that European equities are likely to be more flat towards the end of this year. We have to be very selective where we take our picks, and we are likely to need to see kind of a bit of an earnings reset, so to speak, in order for broader markets to move more significantly higher.
Well, on the subject of earnings, you think earnings are needed to move the market higher, but are earnings expectations already too high given some of the inflationary and growth pressures out there?
We do think that current earnings expectations are a bit too high in terms of where we think they will ultimately come in, both for the end of this year, where we have kind of a 7% expectations for 2022. Next year, we would expect to see earnings down at around 5%. And here the market is still significantly above our estimates, some 10-15 above where we are. And it's a little bit of a mixed situation to some extent, where you could say, well, earnings are supported by higher top line growth. Inflation is to some extent supportive for European companies. So is a weaker euro for those companies that are exporting their way out of some of the pain. But at the end of the day, ECB hiking, high risk of a recession, input costs moving higher, margins being squeezed, ultimately in our view means that earnings are likely to be downgraded further in our view, and therefore that's a lack of a catalyst for what's otherwise a relatively cheap market, but not yet something that we go in and buy in full scale here.
Are financial conditions tight enough, Mark, that it concerns you, or are we a long way off from that?
I think financial conditions have certainly tightened quite a lot. And I think what we've seen and what central bankers around the world are probably pleased to see is that these tightening financial conditions are also causing the PMIs to slow. In the US, we're seeing initial jobless claims moving higher as a bit of a signal that the labor market is slowing as well. And this is ultimately what they're trying to achieve through higher rates in order to get inflation and inflation expectations somewhat down. We haven't seen that happen with kind of the core inflation readings happening just yet, but at least on the inflation expectations component, we are seeing markets moving a bit in that direction. We saw yields coming down a bit last week as well. So I think they're at least seeing a degree of confidence with markets expecting that they will have inflation under control. And we're also seeing a little bit, I think, last week of bad news being good news in the sense that yields came down off of these kind of weaker macro data, but therefore also supporting equity markets.
We see the Bloomberg Dollar Index coming back down to 1273. How much of a problem is the higher dollar, the stronger dollar for European companies?
So I think the stronger dollar, well, you can say that has certainly been a bit of a support just in terms of exports. So in a way, whatever they're selling towards the US or emerging markets, Asia for that matter, has come with a little bit of a tailwind. So I think that is somewhat supportive. Now, I think the issue might be that if the ECB starts a bit more of an aggressive hiking cycle, and you had an interesting interview on that topic earlier today, we could see that the euro might start to strengthen a bit again, just at a time where the many European companies could actually be supported by this weaker euro environment.
Can I ask you about, Mark, about investments in technology stocks? We've heard a bit from various voices in the tech sector. We've heard some earnings. We've also heard some talk about job cuts. Are there any parts of the tech space, specific areas within tech that you think have some upside from here?
Yes, so maybe the way to start it off is that we've certainly had a little bit, let's say, less favorable view on tech or growth-based companies. So generally speaking, for the most of this year, and still have a tendency to like value. With that being said, obviously tech has seen a kind of a significant sell-off, and we do look to those places where we have so-called long-term investment themes that are benefiting from this. So parts of the tech space that could be around security, so IT security or similar is just one where we have kind of a broad investment theme around security that both links to energy security, defense, etc. But here, kind of IT security is another topic as well. That is something that we do like. Yeah.
Thinking more broadly about the US economy, Mark, we heard from Janet Yellen over the weekend, Treasury Secretary. She was saying that a recession is a broad-based weakness in the economy, and we just don't see that yet. And that harks back to some of the comments we got from other Fed officials saying are we really going to see a full-blown recession when unemployment is as low as it is, the labour market as tight as it is? What are your thoughts on the likelihood of recession in the US?
Well, to some extent, you could, of course, say, well, we've been at a place now with so low unemployment rates, extraordinarily strong growth for the last, call that, 12, 18 months or so, that it's difficult to look into the eyes of what potentially could be a recession. But recession typically comes at the turning point, right, where we've come from a lot of strength and now it's weakening. And I think what we are seeing, and I think getting confidence from the initial jobless claims, the PMIs that were out last week, is that we're seeing significant slowdown in the US economy, which, frankly speaking, I'd be very surprised if it didn't, because we still have oil prices significantly up over the year. The Fed is tightened now. They will likely go into neutral territory with rates, another 75 basis points of hike, getting us into 2.25, 2.5 on the Fed funds rate, which is close to neutral territory. So significant tightening of financial conditions, higher energy prices, etc. So it would almost be strange if we're not seeing kind of a slowdown, a potential recession, frankly speaking.
Well, of course, Mark, you're seeing concerns around a slowdown reflected in the bond market, in that the 10-year yield is trading right around 280, about 70 basis points off the high we saw in mid-June. As we see that bid coming back into the bond market, there's a conversation now about the revival of the 60-40 portfolio, which earlier this year had been declared dead. Is that still a strategy that works?
I think we're certainly seeing that there is some value coming back into fixed income markets. So for many of our clients here with UBS Global Wealth Management, we have kind of called fixed income more or less a dead asset class for several years. And this one is now back. We're seeing value coming back into not only treasuries, but kind of high-grade bonds around the world. And we're seeing a lot of our clients that are seeing a bit of interest in it. So yes, it's adding a diversification that we have probably lacked in the beginning of this year, where the very, very low interest rates and the high inflation environment essentially saw bonds and equities down at the same point in time. Now bonds can finally give us a little bit of potential diversification if we're seeing an economic slowdown beyond what we have been doing for our clients around adding obviously alternatives, be it around hedge funds, private markets, which is something that is significantly interesting asset classes for our clients these days.
Okay, Mark, so as we're talking about how to construct a portfolio, there's also a question of how much money you put into the portfolio. How do you feel about cash? Is the time to hold it over? Is it starting to be time to put money to work now that there has been a lot of value creation this year?
I think it certainly is time to put a bit of money to work if you had a bit of an excess cash at this point in time. And certainly if you're a very cautious defensive investor, I think there is value in the safe part of the bond market now all of a sudden, where you're no longer going to lose your shirt like some investors might have done from the earlier part of this year. But broadly speaking, with equity markets as well, a diversified portfolios are still likely to give you a nice positive return, which is, in our view, still quite a bit above kind of cash rate. So that's certainly something that we recommend our investors to do.
Mark, thanks very much. Thanks for joining us. Mark Andersen over at UBS. Coming up on the programme, the WHO, the World Health Organization, sounds the alarm on the spread of monkeypox. So, Dr. Catherine Smallwood, the organisation's senior emergency officer, joins us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Rubini Macro Associates CEO and the BoomBus.com co-CEO, Nouriel Roubini. That's at 8:45 a.m. New York time. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition, but coming up is the original, and co-creator, co-anchor Tom Keene of Bloomberg Surveillance joins us now. So, Tom, what have you got on the docket today?
What we're going to do is recalibrate. Lori Calvasina is with us. Yeah, we've got Roubini. We'll talk about that in a moment. But much more, we've got Lori Calvasina to start the show to say, where are we? After the heat wave, I think I need to ask, where are we? Let's look at the chart. This is a chart we've used many times. Yellow is correction. Down 10%. Red is bear market. The pandemic, up we go. Recovery, we've rolled over. But we are sort of in betweeny. Matt, is how I'd put it, between correction and the drawdown from the peak, December-ish, is Standard & Poor's negative 17%. Dow does a little better, NASDAQ on a chin there, with some NASDAQ doing quite well, but many others struggling.
Yeah, and as you say, Tom, Lori Calvasina turning less bullish, cutting her year-end target for the S&P to 4,200, even though you're looking at the Dow. Meanwhile, Mr. Rubini, what's your top question for him?
Well, we've got to talk about Europe. The charm of Nora Rubini, Kailey, is he's old world. And we've really got to talk about the European continent, the news flow over the weekend, and really how the war links in with what we see in economics, finance, and investment. I think that'll be good perspective from him.
Tom, thanks very much. Really good to speak to you, and we look forward to that program. Tom Keane, co-anchor of Bloomberg Surveillance. Let's get back to the earnings story here in Europe. Philips has cut its sales guidance as inflationary pressures, supply chain troubles, and COVID lockdowns in China led it to miss earnings estimates in the second quarter. We spoke to the CEO earlier.
The second quarter was impacted by a lot of headwinds. We had China lockdown, supply issues, and rising inflation. We have taken decisive action in terms of further improvements on the supply chain, as well as productivity and pricing. We see for the second half of the year a 6 to 9% growth. That is underpinned by a very strong order book. In fact, orders continue to come in. If I disregard China for a moment, we saw 6% order growth and 19 more hospital groups signing up for long-term partnerships. So orders here is not the issue. We are well placed. We just need to get the supplies and the chips and the ships, as Manus just said, in place to deliver on that strong order book. We expect that we are able to do that much better in the second half than in the first half, leading to a 6 to 9% growth in the second half. Still, for the full year, that means indeed a 1 to 3% revenue growth and an EBITDA of around 10%, which is lower than what we had anticipated before.
Okay, so that's the table. You say leave China aside for the moment, but the world is obsessed with what's happening in China in terms of supply chains and economic delivery and recovery. What needs to happen in China and in Asia to materially unlock the blockages?
Yeah, I'm certainly concerned. In China, we saw this massive lockdown that lasted for more than 2 months that affected the China revenue itself, but also further disrupted global supply chains. For example, we have factories in the Shanghai area that were affected. What I understand from the situation now, that it is improving and these massive lockdowns will probably not happen again, but still the risk is there. I really hope that we can see, let's say, a further relaxation of the policies, because we are all dependent on supplies out of Asia.
That was the CEO of Philips, Frans van Houten, on the company's outlook for the second half of 2022. Really interesting, Matt, that he's reminding us that we're not over the COVID disruptions, supply chain issues coming through from a very disrupted China in places, still very much at the center of things for some of these European corporates.
Yeah, absolutely. And we saw a survey over the weekend that most manufacturers think supply chain disruptions are going to continue into 2023 and beyond. So it still is a huge problem weighing on the global economy.
Yeah, and I wonder how much color we may get into that with Apple results coming up later this week, Anna, considering they're exposed to China on the revenue side and then also those very same supply chain issues.
Yeah, absolutely. So any more clues on that, very welcome, of course. As I've actually been noticing that shipping rates, those freight rates for crossing the Pacific have been coming down. Does that tell us anything useful in that regard? Coming up, the World Health Organization sounds the alarm on the spread of monkeypox. Dr. Catherine Smallwood joins us, the organization's senior emergency officer. This is Bloomberg.
I do think monkeypox can be contained, absolutely. The way we contain monkeypox is we have a very simple, straightforward strategy on this, right? Which is make testing widely available. We have done that, and now testing is far more frequent and common. We're going to be releasing hundreds of thousands of more vaccines in the next days and weeks. So there is a very substantial ramping up of response that is happening right now.
That was the White House COVID response coordinator discussing monkeypox on CBS's Face the Nation. The head of the WHO has declared the monkeypox outbreak a public health emergency of international concern. The virus has spread to about 16,000 people in more than 70 countries. We're joined now by Dr. Catherine Smallwood, Senior Emergency Officer at the WHO. Dr. Smallwood, thanks for joining us. We've gone from a handful of cases to 16,000 known infections in a short period of time. Are we capturing all of the infections? How big could this problem be?
It's likely to be bigger than what we know, and that's partly because of the difficulties in some countries in ramping up the surveillance. It's also partly because we're pretty sure that a lot of people with symptoms and signs of monkeypox might not be presenting early enough to be tested. So we do anticipate that we're seeing the tip of the iceberg here. But let me reiterate that it's still very much focused in a particular group, men who have sex with men and associated with people who are having a lot of sexual contact with a lot of different partners.
Dr. Smallwood, what we've seen with COVID-19 is its ability to mutate, and the creation of new variants is what is spurring new waves of infections. What do we know about the genomics of this virus in particular, and whether or not it is mutating in a similar way that could make it more infectious and widen its spread?
Well, we're looking at why this monkeypox outbreak is spreading in a slightly different way than we had previously seen it spread in countries where we are used to seeing it spread. And so different mode of transmission or previously undocumented mode of transmission, which is associated with sexual contact, seems to be driving the cases at the moment. We don't know whether that's a result of the change in the virus. It's a DNA virus. So as compared to the SARS-CoV-2 virus, it should be more stable and less prone to rapid mutation.
In terms of fatalities, I mean, what do we know about how this disease affects people? Isn't it unlikely to kill, and what are longer-term ramifications of getting it?
Well, we don't know about the long-term sequelae of monkeypox, and we're learning very quickly very many new things about the disease over the past 2 months. So that's one particular area of uncertainty at the moment. But thankfully, as you say, there's only a few deaths associated with monkeypox this year, none in the over 12,000 cases reported in Europe. We've seen no deaths reported so far. We have seen people hospitalized. So it's a less severe disease than something like COVID-19.
Okay, and vaccination is an effective tool to prevent infections. Do we have enough vaccines?
No, we don't. And certainly we're worried about the availability and the equitable distribution of vaccine across the world. We also need to work very, very quickly in gathering the evidence base for the vaccination because, of course, we're using smallpox vaccine for monkeypox, which is based on extensive studies in animal models, but we still need to have the real human data. And we're looking at countries to really ramp up the research around that, and that's partly why we've declared this a public health emergency of international concern.
Okay, thanks very much. Thank you, Dr. Catherine Smallwood, Senior Emergency Officer at the World Health Organization. That is it for Early Edition. More surveillance is ahead. A stellar lineup of guests coming up with Tom, John and Lisa in the hours that follow this one. They'll get you ready for that Fed meeting a little bit later on this week and indeed take you through the preamble to all those earnings reports we're going to get this week. This is Bloomberg.